What's up, guys? Ron from Ronald Law, and today for our interview, we have a really exciting guest, Daniel Rickert. He is a multifamily operator, general partner in Colorado.
And we're going to talk about the question, what are rate caps?
So really good question. And I think it's helpful to define kind of what's a rate cap for those that don't understand. So a
Yeah,
rate cap
for
is going
sure.
to have a couple of inputs, right? It's going to have a nominal amount. So $1 million, $10 million. And typically that's going to be tied to the loan amount, right? Because you're hedging interest rate risk for a loan. So $10 million loan, $10 million nominal. It's going to have a strike. And so if your loan is tied to the secured overnight financing rate or SOFR, you'll have a strike tied to SOFR, and then it's going to have a term. So how many years will that contract be in place? High level, that's all you need.
Don't waste money on rate caps. That's just burned expense. Yeah.
That's been the best investment any of us made. Those $30,000, $40,000 rate caps we bought in 21 that are worth, $500,000 today.
If you can even buy them, if you can even get it.
Well, so on that note, most people don't realize that there's a whole market for rate caps, right?
Mm-hmm.
That you can buy them, you can sell them, you can extend them. I mean, it's simply a derivative, right? It's a financial contract. So if you have a rate cap, it's probably in the money right now. And that means that the index rate that it's tied to is higher than the strike on the rate cap.
Okay.
And so it's paying out every month. So there's a future stream of cash flows. And investing is actually really simple, right? What are we always doing with investing? We're saying
time value of money
much for a future stream of cash flows. Yeah. And then I come up with a value by discounting it back to the present. So same thing can be said for a rate cap. I'll pay you $100,000 for that rate cap because it's going to pay out $20,000 a month for X number of months. And I think that's a profitable trade to me.
Well, okay, so this is great. I appreciate the education because I did not know that level of detail. In your example, if it's $20,000 a month and somebody's willing to pay you $100,000, their implicit bet is that the rate will stay in the money for 5 months or greater. Mm-hmm. And you're kind of saying, no, I think it'll be less, or I also value the cash now more than the next 6 months of cash flow, even if you agree with them. But the buyer is almost definitely saying, I think it's going to pay out for more than 5 months.
So
be positive. Yeah.
So yeah, this is actually, I'm glad we kind of opened this conversation super open-ended. We were just like, let's talk about real estate because we both love it. And I'm glad we stumbled into this because people have gotten smarter on rate caps. They've had to. But 3-4 months ago, I was getting calls from all of my peers saying, what's a rate cap? I don't understand this. And
well, who's responsible for evaluating the investment need of a rate cap? I mean, do the mortgage brokers help any of these people, or is it purely a sponsor responsibility?
So really good question. And I think it's helpful to define kind of what's a rate cap for those that don't understand. So a rate cap is going to have a couple of inputs, right? It's going to have a nominal amount. So $1 million, $10 million. And typically that's going to be tied to the loan amount, right? Because you're hedging interest rate risk for a loan. So $10 million loan, $10 million nominal. It's going to have a strike. And so if your loan is tied to the secured overnight financing rate or SOFR, you'll have a strike tied to SOFR, and then it's going to have a term. So how many years will that contract be in place? High level, that's all you need to figure out for a rate cap.
To price the rate cap.
And so then, and if you're really interested, you can actually go to Chatham Financial, and they have an interest rate cap calculator where you can put in those 3 inputs and figure out what the pricing for a rate cap would be today. And so what we were seeing is largely the rate cap purchases were being driven by the lenders.
Requiring them.
And oftentimes the term was coterminous with the loan term because in the lender's mind, right, they're looking largely at a DSCR, a debt service coverage ratio, and they want you as the owner of the property to be able to service their debt. And so they're saying, okay, we'll give you a 3.50 spread, 3.5%, And in 21, SOFR was 6 bips, 9 bips, 0.06%. And so at the time, your NOI divided by your debt service, which had a 3.75% interest rate or something around there, had good coverage. But the lender knew that the rate's floating, and nobody that I know really predicted the rates increasing as quickly as they did.
Yeah, as quickly as it is. Everybody would have agreed on some increase, but we would have thought quarter of a point, 50 basis points, 6 months, we would have time for sellers to adjust and for a market to adjust, raise the rents, whatever. But man, month after month after month is like.
It wasn't the increases. We all model that. It was the speed that just killed everybody. And so the lenders are saying, I need to protect my risk that the floating rate debt gets so expensive that my borrower can't service it. And so they required you to put a rate cap in place. So oftentimes there's a little bit of a negotiation there in terms of, what rate you're going to cap the index rate at. And even the term, right? Some of the bridge lenders said, instead of doing a 3-year term, we'll do a 2-year term. That way you can buy a cheaper rate cap. And so there was some creativeness around that. But what ended up happening is you would go and you get on the phone with a rate cap broker. I mean, those exist, guys whose entire job is to help folks, whether it's in real estate or in corporate debt, hedge floating rate risk. And there are banks that will sell you that contract, just like a options contract. And, you paid them X amount. And then depending on how much term's left, depending on what the strike is, depending on what the interest rates are, depending on the nominal amount that rate cap covers, you can then sell it. Now, likely your lender doesn't want you to sell that rate cap because then it means you probably can't cover your debt services easily. But when you
just have cash. Again, you're trading the value of the rate cap for cash in your pocket, and they don't want to see a distribution to the investors and everybody. So then it kind of circles back to your loan docs. What are you allowed to do with excess cash, and whether you have a lockbox? There's all sorts of very interesting things because, we're working on one refi on Fannie about distributions to the GP and stuff. And, that would fall squarely. It's not rent, it's not income, but it's other income. But is it? It's weird. I think it's almost a product of the sponsor borrower. It's not related to the property. It's a pure financial instrument. So you could make an argument that it's not subject to the lockbox sequestration requirements, if any, because it's separate. And that's what the lender is concerned about. But yeah, it's it can get sophisticated really fast. And it's shocking to me that, my clients have been buying these, but this is the first time I've heard of a rate cap broker, because I didn't know that I just thought the sponsor was like, oh, we need to buy it, or the lender requirements. And this actually another follow-up question. Do you think the lenders were requiring them on weaker borrowers? So it's almost the sharper lenders saved the weaker borrowers because they wouldn't require it for deep-pocketed sponsors that could say, hey, if the rate goes up, we can cover it with our reserves. Or who was being hit with the required rate cap, I guess, is my question.
So typically what you're seeing, right, is any loan that, and you're going to be more familiar with this than anybody given what you do for a living. It's anyone that's securitized has stringent requirements, right?
Yeah.
And so you get a Fannie or a Freddie floating rate loan, they're going to require a rate cap. But there's not going to be a lot of ability to change those loan docs, right? Because that's a securitized loan product, and they're selling to a pool of investors who's going to buy that loan pool, and they are buying it with the knowledge that there's a protection, a hedge in place against rates moving too fast. And so in 2021, there was a lot of bridge debt that was what's called CLO, which stands for collateralized loan obligation. And so it's the same thing. a bridge lender would go out and say, we're going to go and do 10 to $25 million loans and top 50 MSAs.
Starting to sound like 2008 again.
Well, it's funny, right? Because you do run that equivalent. Everyone, you'll hear sponsors say, I don't want to do any CMBS debt. I know what happens with CMBS debt. But then they go and do that bridge loan. You say, that's a CLO. And they're like, a CL what? Right. Kind of like we just took CMBS and we put a different name. And there are some big differences. But
I wouldn't care. Why does the borrower care? I mean, they're the one getting the benefit of a higher credit rating for their debt that's actually lower quality. So they're getting cheaper debt. So the borrower shouldn't care.
Correct. So the borrowers were fine with it. And it was interesting because some sponsors were kind of resistant to being forced to buy these rate caps in 21 because they felt that rates aren't, it's a 2.5% strike. Do you really think SOFR is going to go from 9 bips to 250 bips? There's no way.
Yeah. Or if it does go up, we will sell. You know, when it goes up 50, we'll sell. They just didn't think that they wouldn't be able to sell. And it's funny, it's exactly the strong assumption. Again, I don't know if you read Big Short, where it talks about that. People just had this thing where they said, well, all of these loans won't default. They're spread out. They're so national. And what they didn't realize was like, wait a minute, you don't understand how they're being constructed. They are all the same borrower. And once that light clicked for, I forget the guy's name, you know, whoever was shorting it, they were like,
Michael Burry.
Wow. Yeah, Michael Barry said, it's terrible. It is all the same borrower and it's going to collapse, and it is collapsing now. It's just a huge house of cards. So
one of my favorite quotes of all time, and I have it taped up in my office, is the most dangerous time is when we start believing our own lies. My dad told me that, I think, when I was maybe like 10 years old. And so it's just always been in the back of my head. And I think it applies really well to investing and investing psychology, because you look at the deals you might have underwritten as a sponsor, looked at as a LP in 2021, and you're saying, we'll sell this for a 5 cap in 3 years. We can sustain 7% rent growth. Expenses won't grow that much. Yeah. And I think,
or they said all 3 won't happen at once.
Yeah.
They said, well, we can handle 1 or 2 out of the 3, but all 3 won't happen at once.
And I think in your gut, you probably knew, like, things feel a little overheated, and it's tough because there's always going to be,
you miss out on deals. If you sat out from 2019 to 2021, you missed out on a boatload of money for sure. Yeah.
And so, I mean, I was having that conversation. My dad's in property management and he's bought a few deals, and we were having this conversation the other night because he said the exact same thing. He's like, I just don't understand how people bought all these deals. And I was like, well, I mean, it was because we'd been talking about interest rates going up for a decade, and everybody who sat on the sideline was just sitting on their hands. They couldn't do anything, and they missed out on all of these returns. So I don't fault anybody for doing deals and keeping going. I think it made perfect sense.
Yeah.
But you had to know that at some point there was that party.
Music was going to stop, and you just don't want to be the one, you know, without a seat. That's the kind of the simple answer. And I'm happy to kind of wrap up everything. If you're done, is just, you know, it was great learning about rate caps, but really showing how much some people don't know. And it's scary because if you don't know what you don't know. And this was a perfect example of a lot of these part-time syndicators not even being aware of this, or much less understanding how to calculate or to the need to evaluate whether to purchase them. And it's an interesting time, but the rate caps are coming front and center. I'll quote this. I love this one too, is good debt cannot save a bad deal, like a real estate deal, but bad debt can absolutely kill a great deal. Yeah. And that's kind of what we had with the variable bridge stuff. Was that looked in hindsight, turned out to be horrible debt that is really, you know, causing some struggle. There's capital calls. Operators are pausing distributions, and they're figuring out how to move forward. So
I'll say the same. I'll put this back on you. A good sponsor will make a bad deal work, but a bad sponsor will fuck up a good deal. I guarantee it. So, you know, I think at the end of the day, knowing that we go through cycles, knowing that times get tough, who you invest with is as important as what you invest in. You're betting on the jockey just as much as the horse.
no, absolutely. I think, you know, management is everything. It's really key that if you're a passive investor or you want to be the manager, that you can dedicate the amount of time, focus, expertise to really stay it for the long haul, because you might own this property for a lot longer than you anticipated. I mean, you own stuff and you're saying like, look, can we sell? Yeah, things are trading for a 6 and a 7 cap. We don't want to sell. And you may end up holding it longer, doing distributions, clinging to your fixed rate debt and saying like, look, we're going to push this thing out 7 years until we have to make a decision, but we're not willing, we don't need to sell. And that's a different assumption than I think a lot of people make. They thought it was Beanie Babies, Bitcoin, jump in, make a little money, jump out under the same assumptions.
Yeah.
And it's really not. I mean, the world is changing, and
it's a grind. It's a grind. And
you got to love it though. You got to have the fun. I would say that's my threshold. If I was ever investing with somebody, it's like, do you love real estate? And if their answer is not an emphatic yes, I do real estate in my day job. I do commercial real estate as a lawyer. I make videos for fun. And I go home and I chat my wife's ear off about commercial real estate until she's like, stop. All you do is talk about real estate. Like, I'm like, I'm sorry. I just
have to.
And I invest my own personal capital in real estate. So it's like that trifecta of everything. My work, my hobbies, and my money is all in commercial real estate. But Dan, it was great chatting with you. I really enjoyed it. And we didn't get to talk at all about rock climbing, but well, thank you guys for tuning in. This was a really awesome discussion with Dan. I'm going to rename the interview Rate Caps, an interview with Dan. But smash that like button if you're still watching. Subscribe for more commercial real estate content, and we'll see you next time.